What up, you traders and investors? This is Trade Doc with DGen Ninja here to discuss some broad markets ETFs and see where the market's going. Things have been pretty bumpy. There's a few things going on as far as like government tensions and things like that affecting oil prices, affecting commodity prices, affecting gold prices. So gonna see where the money's going, where we should be landing it, or at least put it in a place that will keep it in reserves for until things clear up and give us a clearer view where things are going. That's pretty much it. So start real quick with USO. So USO was trading at 74.64, translated to futures. Barrel of oil is going for about 105 at the moment, but it was as high as the almost 130s, and that was on the 8th. So that was just a couple weeks ago. So it's come down quite a bit. It looks like it's turning back up. So hopefully tensions are over, or we find some other place to get some oil from. What do you think, Dan?
Yeah.
Is stuff gonna continue, or what's going on? This is just crude oil prices. Right now, sitting at 106.
On the main chart, what have you got on there? Because you might pay to make your background on that main chart not gray, because you've got fluorescent color candles. It's just a bit hard to see, because it's sort of the background interferes with the main chart. You know what I'm saying? It's a bit too heavy.
Yeah. The gray.
I want to make it a lighter background or something.
Yeah, the gray is when the market's closed. So that's like the post and pre-market. So so
your black bands are your swap hours, eh?
The open is here. So USO closed at 74.89, and it looks like it's came up over the weekend because the futures are open now. That's 76.90.
So for people that don't know what USO is, do you want to explain what that is?
Oh, it's the ETN that reflects the price of crude oil. So down here at the bottom chart, I actually have the crude oil futures itself, and that's trading at 106 a barrel. So that's the CL. That's crude oil futures. But when the market is open, during market hours where you can trade options, you trade USO. That just reflecting the price of crude oil itself.
Do you want to explain to the peeps what ETN means? Obviously, it works similar to an ETF, but you do have management fees for holding the index investment product. It sort of works like slightly like a index fund, but more tied towards a commodity index. Is that how it works?
Yeah.
You do pay a small amount of management fees for holding the position, eh?
Yes, because involved with an ETN, obviously they're managing the options for it, and you're trading it. So you're trading it only between like pre-market, during market hours. Let's just say between 9:30 and 4 o'clock, you can trade USO. After that, you're trading futures, which is crude oil. And with the futures, there are no management fees like the ETNs, because they have to support your whole option.
So the advantage of ETNs or trading ETFs on the US stocks is that you can go long and short without actually having to short sell. So like you can buy an inverse ETF or inverse ETN that mirrors the inverse of what price is doing. So if you were, say, bears on oil at a certain time, you can buy the ETN where that price is reflecting in the market. So obviously if USO drops and you bought a bear ETN on oil, then you'll be gaining. But you don't have to, it means you don't have to play futures or derivatives, and you don't have to short sell anything or open any margins or leverage positions where a lot of your capital will be at risk, tied to what the commodity is doing at any moment in time. Your losses are limited to what your investment is in the ETF or the ETN. So it means that if you entered crude ETN shorts at 130, say, and it's now 104, obviously your stock value would have gained heaps, because there's a leveraged element to the ETN. So that leveraged, that leveraged ratio is varying, but it kind of reflects what it is relative to what the actual derivative is doing on the futures.
Like for example, in the futures, we'll take here the 15th, whereas on the low, the futures are trading, the lowest was 93.45. If I take it to now, it's up about 13% from the futures. That's from
you can get the ETNs are not usually 1-to-1. It's usually like 1-to-2 or 1-to-3 or 1-to-5, depending on your risk appetite. But obviously your leverage ratio, the higher it is, if it's running in your favor, then you're going to get massive gains. But if it goes against you, like you can always buy an inverse, triple inverse or something, or double inverse on the shorts.
There are those, but just for example, like USO does reflect crude oil, because if you can see that measurement, if I take the low of the same day, the 15th, and I put it to now, it's still a 13.6% increase. So the ETN or the ETF only pays the fees to the broker or whoever the management company is, whether it be Barclays or Direction or whoever created it. It's like a small fee, but that's what's good about it, because you can just buy USO or sell or short USO, and they'll just follow the price of crude oil. You don't have there's no you don't have to roll the month over when those contracts expire. You can just hold USO for a year or throughout the years, and you're paying a very small fee, like 0.03%, which is pretty minimal, and that goes directly to the brokers, and they take that fee out of the stock price every day. So it's pretty safe versus having a lot of capital in order to trade the futures. So in order to trade futures, for example, to trade one share of USO, I believe you have to have the 2,500 or per one.
Is that many future contracts or standard?
Just for one future contract.
No, but standard contract or mini? Because
that's for a standard contract. Yeah.
Okay.
The minis would be less, like less margin.
Yeah, but to enter your initial position on one lot, that's $2.5 grand, and then you have to cater in your buffer. So your capital would have to absorb any ups and downs in the volatility. So you probably need 10 grand minimum to trade even one standard lot.
Yeah, so like say with 3 at a minimum, but then you're only trading one lot in the futures. So if it goes down to 500, you're almost liquidated, pretty much.
Yeah, but then normally retail accounts, even on leverage trading on futures, you wouldn't trade a standard lot. You might trade a fraction of a lot, like a 0.2 or 0.1 even.
You're not allowed, not in the futures. In order to trade the like a micro lot, you just go into like a not /CL, not the CL itself, but like the micro.
You can do it on most forex broker platforms. You can do fractions of a lot, mini lots, but on the stock market, I think you have to just stick to what they got.
Yeah, like just yeah, on the micros it's a lot less.
Yeah, it's
So that's
probably
why
more
I
a
pretty
standard
much
play
trade
for
the
retail
micros.
traders. You
Yeah,
got
for
any other
yeah.
charts to go through, or?
Oh yeah. So this is just the crude oil. Now XOP. XOP is trading at 125. As you know, those are the oil explorers. They're the ones that go out and dig, research, explore for oil. So typically when oil is up, so are the oil explorers because it's worth it for
Yeah.
them to open up new
So
drilling rigs.
for people that don't know what XOP stands for, is that the energy ETF? Is it energy
Yep,
sector?
that's an oil and gas explorers
Oh,
ETF.
okay.
So it's a collection of um, companies that do oil exploration and natural
Yep.
gas.
Yeah. So
So
like your
that's
BPs and
XOP.
your Exxon Mobils and all them, those kind of guys.
Exxon, those are like the providers. So that'd be under IOH, which is oil services.
Oh yeah.
And so that's the energy. So pretty much start with the crude commodity itself, and then the companies that branch off of them. And, for the first time, if you want to see companies that are in it, you can just Google the holdings for IOH or the holdings for XOP. Now, those are ETFs because they actually comprise of companies.
Yep.
Uh,
Rather than commodities.
USO is an ETN because it only reflects the price of that one commodity. So that's the
Yep.
difference.
Yeah.
Um,
Same with gold futures and all that.
yeah, so next is UNG, is natural gas. And natural
Yeah.
gas is actually above almost $5 again. Above it was trading at $2, $3 and got manipulated down lower than $3. So this is UNG, which is the ETN,
Yep.
and that's trading at 17.22. But the future for natural gas is at $4.90, which is actually uh, almost 100% higher than it was last year when it was trading around $2.09.
Well, the geopolitical factors come into play in there because natural gas was pretty much suppressed
Yeah,
due to
definitely.
demand supply economics. But now with Russia being sanctioned and with them being like a 12 or 15% supplier in world um, natural gas markets, and with them being sanctioned, then that takes out a lot of supply in the market, and so that is a driving factor in natural gas futures going up the last month since the war, Ukrainian Russian war.
Yeah, and looking here, like between
Yep.
September and November, we were upwards between like 480 to 620, which is pretty high for natural gas.
Yep.
So seeing, and right now it's kind of like in this price box where it looks like it's going to the top of the range. So I don't see why it wouldn't go back up to the $6 range or above the 550 mark. So that's just a heads up on natural gas.
Yeah. Well,
Even though,
if the big banks do short it down below those equal lows around 3.5 and break some backs, I think it'll be a pretty safe bet to go long anything below 3.
yeah,
Um,
definitely.
Pretty heavy. You can pretty much have a pretty high risk to reward
I mean, when
going
things
below
were
3.5 even.
were
That's what I
pretty,
would do.
when things were should have been going up, when we had bad winters and everything, they actually pushed it down because there was just way too many longs. So it was just kind of
Yeah.
easy money for them.
Yeah.
Now, they're using a lot. They started using a lot of natural gas for electricity production and power plants. They're trying to get away from coal and stuff. So that's probably why the price has gone up within this last year. But again, it's kind of one of those commodities that I expect it to keep going, trickling up higher just
It's going to
because of
break that
things that
trend
are
line.
happening.
It's going to break
Oh
that
yeah,
trend line.
definitely.
it's going to break that trend line just because a lot of shorts we stacked on that descending wedge trend line, and banks like to target indicators when they grab liquidity. So it's going to break that 575 plus, at least a very big long wick up, if not just to take people's margins positions out.
Yeah,
it kind of wick up and come down even and retest.
Yeah, I mean around $6. I think fair price, because I always look at fair price, would be like between like 4 to 6. That's kind of be a fair price. That should be consolidating like that for a year, but you never know.
Yeah.
And between the $4 and $6, so 50%, you can be making 50% up and down. So that's why I like to trade it sometimes, because it's volatile. But yeah, it is manipulated like that.
The lows between November to start of March, that's a pretty solid equal line on that longer time frame. That 3.5 or 3.7 line. That's a lot of long liquidities there. I expect the biggies to come back at some stage for those longs. It's because there's too many bulls stacked on that line there, bro. It will break that line again in the next few months, hopefully. It's not a short-term play, but they'll eventually come back down to those positions, I'll say.
Yeah, I could see the retest of 4.5, but definitely if it's going to be, say, a 3-month outlook, like the ranges will be between 6 and 4.5, which would be safe to say that. But that's for natural gas.
Any wick below 3.5 would be a very sudden and sharp wick and sharp reversal. So that's why I see this pretty safe play up below 3.5. Have longs pending, and if they do try and liquidate 3.7 positions on that equal low line, then you get wicked in and have a pretty high chance of having next to zero drawdown, and it V-shaped rebounds towards back over 4.5. So, that's pretty safe play. Any other charts you want to go through, bro?
Yeah, is XLE, which is the energy sector, and this is looking at 128 days, and you can see the highs were at 80. Right now trading at 73.88. I have a chart in the bottom, which is the leveraged ETF ERX, which is the triple leveraged for XLE. And, it's good for swinging, but only intraday. And you can kind of see that it only shows the movement while the markets are open.
Yeah.
So that's why it kind of looks like that. But it's more of a kind of look at it to gauge, because there's a lot of good company in the energy sector, XLE. So I mean, it's consolidation. Could be, you see it holding like the 71s or the 70s, but more or less until things clear up, things get cheaper, it'll be traded between 80 to 70, it's safe to say. You can go into XLE and look for the strong companies and short the weak companies and do some sort of pairs trading, just to take advantage of the movement.
Yeah.
But this is more of a consolidation, typical of a wave 4. So yeah, it will go up and at least touch the $80 again in the next coming weeks.
One thing for you guys out there in the audience is that when you're on a macro time frame, on a longer term play, keep an eye on the Elliott wave count. Basically five waves up and then an ABC down. If it follows the pattern, it should have a higher high and a higher low. So markets, if you actually zoom in closer to one of the recent moves from a swing low to the swing high or current move, you can actually see a very good Elliott wave pattern. So
Yeah.
that gives you an idea of where you are at in the sort of in the multi-week kind of time frame, or even
Right.
1 to 2 months where you've hit a significant low, swing low in the reversal, you know, that, you know, you've had your ABC, your big dump, and then it sort of bottoms out, and then you start your counts again, 1, 2, 3, 4, 5, and then you kind of have to look for the ABC, that Wyckoff distribution, short, retest, fail, slam. That's usually a pretty sharp one. If you're looking to short something or buy an inverse ETF, that's the time to do it, where retest is the B. So that's just a little tip, trading tip for peeps out there.
Yeah, yeah, definitely helps to know where you're at in the count, because it'll give you a better spot where you want to enter and exit, or know whether it would be bullish or bearish
Yeah.
is the reason, just to be biased. And as long as you follow the rules, that's all you could do. Nothing's perfect in Elliott waves. Everything's theoretical, but it works. I don't know.
Well, on the
Don't ask questions.
TA standpoint, I try and avoid a lot of fancy indicators, but I look at volume, I look at fib, retracement levels, key.
Yeah.
Elliott waves is another one for macro trends. And the other thing I look at is liquidity areas, so equal lows and highs. And also, you know, like roughly where the sector's going. If it's like a stock ETF industry, like I look at sort of like the longer term fundamentals, you know, for example, if it's tech stocks, I'll look at sort of like, you know, chips or something that's sort of bullish long term. And then you're going to keep in mind that it's always going to be slow, gradual bulls, and then the sharp sudden bears. You know, when it tanks, it just goes real quick.
Definitely.
But when you're building momentum, it's always a slow bull, you know, Elliott waves, you know, it kind of gathers momentum and tries and shakes off the weak hands, and then it goes the next way off like that. But then when it does tank in a bear market, it just goes, and that's fast money too when you time your shorts good, because you make your risk to reward real quick. And when it dumps pretty hard. Like it might take weeks to go get up to where those high points are, but it might take, you know, half a day to just tank, you know, back to zero or whatever, or ground level.
So what I do is on all these charts, so I have a list of companies in XLE. So you can see we do have Exxon, Chevron, Chamberlain. So these are all the ones, and they get rebalanced. So you kind of have to go look into Yahoo to see which ones are the heaviest weight. But here you can kind of see what happens. Like, for example, Occidental Petroleum was down 3%, while Phillips 66 Com was up 1.5%. So you can pairs trade it or just go with the stronger one. But here, just looking at the chart, you know there's going to be a consolidation. So I'd rather be like 2 long, 1 short. Just have a bullish bias, or at least a neutral delta, where you're actually waiting for that breakout or waiting for that high retest. But if you're bearish, then maybe you just want to go back and short
for traders, for traders or investors that are in retail, like retail traders. Basically, the advantage of being in ETFs is you spread your risk, because there's a diversified portfolio, a basket of companies in the same sector. So you're not overexposed to any one company, which is really good for a longer term play. Because, like, let's say if ExxonMobil has a bad, you know, fundamentals or bad news coming out, it's going to really hit that company. But what this does is it kind of negates that one horse effect on your whole portfolio. So like if you have like an ETF based balance approach system, you're not overly exposed to any one company, which kind of lowers your risk in your portfolio of any bad horses that kind of like sells the whole pack, so to speak.
Yeah, like you're not like right there in the bottom, say I did have just Chevron or Exxon Mobil. Say I did just have Exxon Mobil at the bottom. It'll follow the chart a little bit, but not
Yeah.
exactly. You can kind of see the difference, not change
Yeah, the
comparison.
index kind of balances out across the board, and you'll find
Right.
that on these hedge fund ETFs, they do have higher weightings on bigger cap companies. So
Yeah,
your
they do.
macro caps like Exxon or Chevron would have a higher percentage in your ETF basket, and your mid
Yeah.
cap to small cap energy companies would make a smaller percentage anyway. So that in itself balances out and takes out the noise from your volatility, your day-to-day volatility.
Yeah, definitely a lot less volatile than just holding the stock itself.
Your trade-off though is like you miss out on winners. Like if you do pick your horses and they do perform better than the market, that's when holding individual stocks would give you a better risk to reward. But for mainstream retail traders or investors that they aren't full time in the markets, like you don't want to be overly exposed to any one company or a handful of companies. So you want to have a really diversified portfolio stretching across different sectors. So you're kind of protected, like say if EVs take a dive, you're not going to take a big hit in your portfolio overnight, you know what I mean? Or like have a heavy tech stock allocation whereas this year is a rate hikes year, you want to be more defensive, you want to be more exposed to like financials and banks and institutional banks, like for example like a JP Morgan or a Goldman Sachs or something, like where interest rate hikes would be beneficial to banks. You're expecting an overall retracement in the S&P 500, but then you're kind of protecting your portfolio with solid industries or solid sectors that's going to be up long term, regardless of whether the index is retracing or not. And the fact is, now it's not like 2 years ago where everything was going up exponentially, like all the growth stocks with no or very poor fundamentals would be going berserk for no reason. Now it's back to reality where it's sort of like old school fundamentals, whether it's got a good dividend payout, is it a solid company, is it making money, like chances are your loss makers, your small cap, speculative plays are, a lot down from last year. Like if you're buying in last year, you'll probably have a 50% tank in your portfolio. But it's more about rebalancing it towards stronger companies, performing companies, like say on the US 30 or something. Like a defensive stock would be like a AT&T or one of the financial banks, like a BAC even, or Citibank or something, or even something like
whatever protects the trend. That's kind of like
what's
good about ETFs, because if
even strong
say
tech
tech is
stocks
out,
like Google, Amazon, or Facebook, even, like they are like your lead ponies. They ain't gonna like just dive to zero, so you're gonna have a pretty good chance of them coming back, making a strong comeback in the next couple of months, even though it's rate hikes here and it's probably retracing quite a bit. But then that you've got solid dividends behind you, so you're not worried about holding the good stock. Whereas if you're holding a company that's very speculative and it doesn't have any fundamentals behind it, it could go to zero or near zero. Because chances are you're going to get dumped on, and the hedge funds aren't going to buy into those weak ponies. They're just going to let it free fall and short them.
Yeah, exactly. They're going to short the individual stocks themselves. But good for the noobs would be like 5 industries. I was doing that before, just taking 5 just strong industries. Say tech is doing good, energy, oil is doing well because of things that are happening. Utilities are doing good.
And then you probably want something like consumables, like or healthcare, which is pretty strong.
Healthcare is in there, but they have it for everything. Like this is utilities here. XLU is utilities, and usually they're like a safe haven. So when things are going down, it's kind of like utilities and gold is where peeps go.
Another recession-proof stock would be something like Coca-Cola. Like that's sort of your buffer choice. You can't go wrong selling puts at lowball prices because one, if you're not getting exercised, roll your weekly options and you're getting paid. paid for rolling them. Or secondly, if it does tank to those low ball prices, you're buying it and it's a fairly safe bet that it's going to come back.
Yeah.
And then you've got a strong dividend too.
Way.
Fairly good investment where you've got a ratio between your price to dividend or price to book is a lot lower, when the price tanks. So you're getting better value for money. And obviously your price to earning ratio drops too, which is good for you if you're buying in low and selling high.
Yeah, like this is XLU safe haven, so you can kind of see why it's been up for the last couple of weeks with the uncertainty that happens. So utilities usually hold up while everything gets sold off just in fear and things like that. They jump into utilities because everybody needs those. But here you can kind of see that this is XLI, which is the industrials, and just because of the price of materials, you can see how low it's been. So this is from the 1st of January on. First the year started at 105, came down to the low of 92 on February 24th. So it seems that's kind of like when things were starting to get uncertain. Material prices were really high. So now it's kind of coming back, and this is the industrial sector. So it's a good sign that it's coming back, but relative to the rest of the market, I mean, relative to its historic price, which is above 100.
Industrials,
it's kind of like right there in the middle.
And your materials are sort of like your long-term ponies. They're pretty stable. I mean, they're not going to be exponential like surge like a text, but they're sort of like your everyday, day-to-day industry. So they're not going to fall away. They're quite solid. And with inflation being it is at now at 40-year highs, the cost of building materials, etc., they're going through the roof. So I think it's beneficial for any companies that is sort of supplying, and usually they've got pretty good dividend payouts, but sort of more defensive stock strategy, if you know what I mean. Like if you want more protection in your portfolio, you'll have a higher allocation to something like energy or utility. But if you're, say, a fairly young fella, you probably want more exposure to healthcare or tech stocks where you're going to get a higher growth for your portfolio over time.
I mean, this is the material sector, and pretty much I've seen that as prices and inflation goes up, the material sector reflects that.
Yep.
And here I have like the volume profile and the point of control, which is pretty tight to the downside. And it was this week that it started popping up with some pretty big volume. So that just shows that things are going to get more expensive pretty much, whether it be because of inflation or the cost of oil for transportation, but the material itself at the end will be more expensive to receive, and then you'll have the production costs and things like that. So material sector, I do see it going back up into the 90s, into, the highs was 92.30, and that was January 5th. So I can see it easily keep on drifting up there through the summertime.
Yep.
Unless,
sort of like
which I doubt it.
Probably third quarter, probably.
We're going into the second quarter.
Yeah, I'll expect it to sort of test those highs around the third quarter, I'll say.
Yeah.
The latter year.
89s around there. So and then I have FCX, which is one of the biggest weighed ones, so that's why I have it in comparison the bottom.
Yep.
So FCX pretty strong, deals with oil, gold, more mining based, but it's one of the biggest company in that sector.
Where are you at with your chart sharing? Because we might have to maybe do another show just to carry on, because I think we probably gone into quite a bit of detail today over industries.
Yeah.
Do you want to make another summary maybe next week or something? Or do you have something else to say today just to cover? Anything else you want to just cover as a last thought?
Pretty much I wanted to cover what we did, which was the energy sector, the oil prices. That's the stuff that's most concerning right now. That's the stuff that there's a lot of speculative money in it, and that's the stuff that's actually affecting us at the moment.
Yep.
So I can see a lot of volatility happening in there. There's a lot of intraday swings as well.
Yep.
The option premiums are high across
Yep.
those sector, service sector, oil and gas explorer, the ETN itself, anything related to energy.
Another tip for traders is that, you know, you're always looking to sell options when implied volatility or IV is high, because you're going to get good premium. So you want to roll your options against your stock holdings, and then roll the wheel strat, you know, selling puts when the price is low, and then selling calls towards the sort of like the outbreak, you know, on the high end of your Bollinger Bands. That's how I do it anyway. And then I collect premiums both ways. You know, milk it both ways. Either get exercise low or selling high, or I bank the premiums. So I just roll into the next week or the next couple of weeks, roll it out. For stock options, it's better to roll probably 4 or 5 weeks out, just so that you've got enough time on your hands to flip them.
5 days out, just to suck up that
yeah, because that's when the IV is at the highest. Your decay, the options decays, starts decaying at the fastest rate, and that's when we bank a lot of premium. And if it doesn't do anything, we get paid for waiting, which is pretty neat. Whereas if you're buying options, it's pretty speculative. If your options doesn't move up or move down, if it stays sideways, then you're losing, because it's not doing anything and time is rolling by, and then decay eats into your option price. So that's another tip for you guys out there. So I think that's pretty much for today. We'll call it a day, and then we'll probably do another episode early next week, same time.
Definitely.
Okay. So thanks, peeps, for tuning in. On the headquarters here. We'll see you next week. Adios.